Good morning, everyone. First of all, I would like to thank you for taking the time out of your busy lives to join us this morning. As much as I'd like to think this is about me and you're all here to see me, on behalf of everyone here at Shillin Wealth Management, I'm happy to welcome our special guests today, Connor O'Brien and Mr. Wonderful, Kevin O'Leary. If you would look at your portfolio invested with us, you'll likely see one or two funds managed by O-Shares, and that's by design. O-Shares Investments does an excellent job of keeping us informed of changes to their funds, as well as what they're seeing in the markets. So with a team approach to investment management, we really do rely on our partners like O-Shares throughout that entire process. But what we appreciate most is that they always make time for us and our clients like they are today. So with that, I'll turn it over to Connor to introduce himself and Mr. Wonderful and get us started.
Great. Thank you, Jake. We'll have you back on for Q&A in the latter part of the call. Thank you, everybody who's joined us today. And Kevin, good to see you.
Thanks, Connor. Great to be here.
So before we get into talking about the economy, let's just tell people a little bit about life in the bubble. For those that don't know, Kevin was, of course, again on Shark Tank shooting the next season. And what ABC did was take over an entire complex in Las Vegas. Just share with people a little bit about that experience.
Yes, we took over the Venetian Hotel. It was going to be used for hockey bubble, but we used it as 1 million square feet, 268 people locked in that building for 6 weeks, tested every 72 hours. It was successful. We were able to keep everybody safe, shoot a show, but the compromise was you were in a virtual prison, a nice prison, but still you couldn't go outside. And it worked. And I think that'll be the future of how television is shot next year until this COVID is well behind us.
So what is it about Shark Tank that's made it such a huge success?
I think it's really, the distillation of the American dream. I mean, not everybody makes it, but, there's a huge human drama that plays out in people that are starting family businesses and sometimes becoming wildly successful or other times not so much. And so it's a great platform to launch a business, and it's different than most reality that you're throwing mud at somebody or you're on an island. That this is a real human life drama of business and of real capital being deployed and real companies flourishing or going under, and I think it's very compelling.
And it appeals to people young and old. It's a fantastic show. It's now season 12 behind us, season 13. We're looking forward to it. What's going to be different season 13?
Well, season 12 just went in the can and will start airing. So there's a tremendous focus on plant-based foods, a lot of vegan, a lot of health focused businesses, a tremendous amount of focus on direct-to-consumer digital technologies that do that. Very little focus on retail. So you're not going to see a lot of products that are distributed through retail in season 13 because of necessity. That's the sector of the economy under tremendous stress. And, we were just blown away by how many innovative ideas came out of that, people have been sitting in their basements for 6 months dreaming up some pretty interesting solutions to current day problems.
There's some amazing wins that people have had on Shark Tank, and there's several that I love. I love the cupcake story. I love the Albertsons plated buyout for $300 million, and I love Blueland. There's so many others, but maybe just tell people the soundbite of what's made those three big successes.
Well, Blueland is probably one to focus on. I mean, it's on trend. It basically crystallizes dish soap and cleaning surface fluids and laundry detergent without using plastics at all. And so you're shipped a capsule and you put it into a reusable glass bottle or reusable plastic bottles you don't throw out, and you save, the lugging of 2 pounds of water from the grocery store. You save money and you don't pollute. And, that's a business that was scheduled to be launched into retail the week of March 7th. It did a complete digital pivot and started selling direct to customers at a full gross margin. Never had that plan, but they were able to do it. And now they're doing $3 million a month from scratch. So that's going to be a very successful business, probably be acquired by one of the consumer goods companies in a couple of years. But it's growing like a weed, and it's using remnant cable and social media direct-to-consumer strategies, and just that's the best way to sell product.
So each of these companies really fast-track becoming values of 100 million, 200, 300 million company values. So let's step away from Shark Tank and let's look at the broad economy. Everybody on this call knows the economy was essentially shut down sometime in March, and there's a lot of money thrown at the economy and at consumers by Washington, both the Federal Reserve as well as Congress. And it's now 6 months later, let's call it. What are some of the top-down views and things you've learned as the economy has essentially gone through this 6 months? The stock market is pretty much near all-time highs. What's really going on with the economy? What's really going on with people's investments?
Well, I have over 50 companies now, all private, in that portion of the portfolio that, are companies I've invested in. And we don't manage them on a mark-to-market equity basis. We look at free cash flow. We get tear sheets each week of every single company, of the revenue and the free cash flow. And so we mark-to-market the value of a company based on its discounted cash flow, because that's all that matters when you're a private company. There's no analyst talking about the stock price, so it's not something we look at. But in March, for the first time ever, getting this data each week, we saw every single one of our companies go to negative cash flow by the end of March, which has never happened before. And that was effectively, if you think about the distribution pie chart of revenues for any American mid-cap company, many of these are mid-cap, small-cap, 50% comes from retail, about 40% comes from Amazon, and 10% comes from their own website. That's generally how it looks like. And the dollars coming in from retail are 50 cents on the dollar. You pay a 50% margin to distributors and the store chain or whatever to sell. So when they all shut off, we had a pretty chaotic period there. In addition, we had sectors of the economy like food services, cruise lines, weddings, sports arenas, office service. Those businesses were really stressed because they had not just distribution issues, they had no revenue. Their businesses went to zero in terms of revenue. And when we're now with the knowledge of almost 7 months since then, the outcome's been rather remarkable, and I'm very optimistic because the companies involved in travel or wedding or lodging or cruise or sports arena service, I've come to the conclusion they're going to go to zero. It's not anything the government can do. It doesn't matter if there's another PPP loan. Consumers' behaviors have changed, and they have changed for an extended period of time. We provided services for airlines in the food area, that kind of thing. And I don't think it's going to be the same. It may be better, but I'll say why. So those companies, I am not putting any more capital into, and I'm no longer supporting PPP requests because there's no point, and I'm a taxpayer and I don't want to waste my money. On the other 75%, this is where the news is exceptionally good. We have seen a remarkable digital pivot, and I'll give you an example. Let's say you had a store in, let's say you're a business in Chattanooga, Tennessee. I always use Chattanooga as my favorite example. I love saying Chattanooga, Tennessee. I've been to Chattanooga, Tennessee. I'm not sure everybody listening has. Wonderful place. So store closes. We know we have a successful business there. We know we have customers from 80 miles around, but we're closed. And this is in March, and we all of a sudden have no revenue. So what we do is we license a Shopify store platform. We go to Facebook Shop and Walmart for logistics on our inventory. And we announce to our existing customers, not new customers, we're just trying to keep the existing customer base, trying to stabilize revenue, that we're still in business. But now we have the added convenience that we'll ship it directly to you. Now, normally when you would do a campaign like that, you would get 2 or 3.5% response, and that would still be a good high single-digit, low double-digit return on advertising digital spend. That's not what happened. We started getting 15, 20, 30, 40, 50, 60. The highest was 66% response from existing customers who said, oh, you're still in business. Yes, I like that product and know it. Ship it direct to me. Now, why you would care about that is that if I used to sell that customer the product through retail, I made 50 cents on the dollar. Now I'm selling that customer direct at 100 cents on the dollar. So theoretically, I can cut my sales in half and be agnostic to free cash flow. And that's exactly what the tear sheets say. What they say is it took 6 months, but we're now ahead of fat cash flow forecast, even though at a lower revenue rate. Same thing happened with Nike this week. They reported 33% direct-to-consumer sales of their products, way ahead of what they thought was going to happen. Digital sales up almost 100% at Walmart year over year, same with Target. Bed Bath & Beyond closed 200 stores, but digital sales were up 75%. That's one of my big customers. So you're seeing this digital pivot that is extremely productive in terms of gross margin. And so for 75% of my companies now, they have used the technology available to them to completely change their business model. And here we are with a lower rev line with a higher free cash flow. And I can assure you, as I manage that portfolio with my team, we care a lot more about free cash flow than we do revenue. And so the reason the market is so buoyant is that they see the S&P is going through this too. The companies that have figured out that there's a new, more productive America on the other side of this pandemic, a more high margin America, a better, more focused direct-to-customer America, are very interesting to shareholders. And that's why you've seen such buoyancy in equity markets.
So the economy goes through this dislocation, markets come right back. One of the questions is portfolio adjustments. As a high net worth, ultra high net worth investor, you, your family trust, your family wealth, you've made some pretty interesting adjustments. Why don't you talk about what you've done there and tie into it, the prospect for inflation sometime a year or two down the road?
Yeah, so I mean, typically, and this is probably no different than many of the people listening, I mean, we manage several family trusts and some operating companies within my world to distribute 6% of assets under management each year. And so we're looking, and generally that mandate would have been for decades, 50% fixed income, 50% equities. We have changed that this year for a few reasons. Obviously, the fixed income market is not as productive as it used to be in terms of providing yield. It used to be a 6% world, a decade ago. Now it's a 3.2% world, and you're taking duration risk on BBB corporate credits. And government bonds, I wouldn't buy anymore. I mean, a 30-year piece of paper with an under 2% yield seems absurd, because it is. The risk you're taking there is inflation, and it would really hurt if inflation showed up in the next 30 years, which I'm sure it will. So it's sort of a pivot to now 70% high-quality dividend-paying companies and 30% fixed income. So our mandate in fixed income makes about 3% across bank loans, pref shares, factoring, converts, prefs, whatever, and BBB and above investment grade corporate credits. So, that means we're 300 basis points away from the 6% distribution. So we have to rely on better performance on equities, which we do. So it's now 70% equities. And the kind of equities I own, obviously I'll speak to what I had a hand in creating, O shares. Those are rules-based ETFs that focus on balance sheet quality. Certainly OUSA is my largest holding by far. It's the most boring index in the world. It has the highest quality companies carved out of the S&P 500. There's many S&P companies I would not own today, but there are many that are going to continue to perform with high return on assets and distributions of their cash flows, and I want to own those, and so I do. And other indices like OGIG, which is a product that focuses on internet giants. Those are the companies I buy all the licenses from to run my own businesses, so why wouldn't I own them? The Facebooks, the Amazons, the DocuSigns, the JD.com, all of these global internet giants have been a very good investment in the last couple of years.
So you talked about shift from fixed income to equities, and I'm just going to mention a couple of numbers for people that might be wondering about it. So if one has a fixed income portfolio yielding, pick a number, 2%, 3%, and you shift into equities where the dividends are coming from a very diverse set of companies, as in OUSA, the ETF that Jake and Shillin know about, you get almost the same income, and you get income growth. And the history of the stocks in the OUSA portfolio, just to use an example, the history is that the dividend rate has grown by more than 10% per year. And so that is a reflection of the businesses growing, able to generate more profit every year, able to pay out more of it every year, and the owners of those stocks getting an increase in their income level as each year goes by. Whereas, as people know, with a bond, your income doesn't go up. You're just hoping that when you get your money back, you get it all back, and then you can invest it at a decent rate. So anyone who's really thinking hard about their income and fixed income mix, definitely suggest you chat with Jake about it and look at your dividend strategy as one of the ways to grow your income. Anyhow, I'm not here to be the advisor, just wanted to make sure people understood what they can get out of a high quality portfolio of stocks that Kevin was describing. So Kevin, let's talk about another aspect of investing, and it's private equity. And Jake asked that we just put this question on the roster for you. You obviously have private equity interests in 50 plus companies, some of which you've touched on briefly in this conversation. Companies that you've invested in through Shark Tank, companies that have invested in other ways. Almost nobody in the world has the opportunity to do what you do, investing that way. So for people that are living in the rest of the world, not your world, what's your suggestion for them on how to invest in private equity? Does it make sense? What are your comments on the liquidity or lack of liquidity problems? What are the pros? What are the cons? Not necessarily the final answer, but what are the benefits and what are the disadvantages of private equity investing for the typical high net worth, ultra high net worth person?
Well, I've always been in private equity, for about 20% of the portfolio, and primarily that was done through large PE firms, but I don't use them anymore because I have a very large portfolio of direct investments myself. The advantage of private equity is generally in a portfolio you're going to get, recently it's come down a bit because there's so much competition, but call it 8 to 17% annual return. I know that's a wide range, but that's it. For me, it's sort of the last few years has been 15% a year. But you have to realize that money is completely illiquid, and so generally speaking, the portfolio pays distributions. But in terms of actually liquidating it, it would be impossible. So you get double the market returns in some cases, but the cost is complete illiquidity. And so if you're using, if you have 20% in private equity, the negative is if you want to rebalance, there's no rebalancing. You can't all of a sudden, sell a private. There are markets where you can try and do it, but the discounts are like 30, 40%. It's not great. I would also say that managing a private equity portfolio directly, as I do, requires a lot of people. We have to watch every month what's going on with the portfolio. That's why people go to PE firms instead. But my bet, if you were to put money to work today in private equity in a big PE firm, you'd be disappointed in the returns 7 years from now. They're going to be in the middle to slightly high single digits because PE firms are now under tremendous competition in the market. SPACs are an alternative. You might have heard of those. They're overpaying for all kinds of assets. And the market is awash with liquidity. So, I argue to people, even high net worth people, you should put a value on liquidity. You really should. Liquidity becomes extremely valuable when you need it and you don't have it. And so, that's sort of, I tell people today, to be very, very careful in tying yourself up in assets like real estate. If you're putting new money to work, I think cap rates are going to go up in AAA office in New York and Boston and Miami and Detroit and LA. I don't think everybody wants to work out of an office anymore. It's not going to be quite the same. I'm not saying no one's going back to work. It's just maybe 10% don't, or 12 or 15%, as I'm learning in my own portfolio in the areas of accounting, compliance, logistics. Those people don't want to come back to the office. They want to raise their kids in the suburbs, buy a slightly bigger house, have a backyard, all that stuff. And I'm seeing that happen every day. So there's a new world coming, but it's a good one.
There's a lot of uncertainty on some asset classes like real estate, travel, lodging, all of the entertainment space. Talk a little bit about your views on international investing. This is another one Jake put on the roster here. You know, the U.S. has outperformed the rest of the world for quite a while here, with some exceptions. The e-commerce and internet services categories outside the U.S. have been phenomenal performers. But you've got certain countries that are dominated by energy or dominated by state-controlled, government-controlled mining companies, government-controlled banks. So that's can be tricky. You've got Europe, which is different world than Asia. What are your thoughts? What do you do with your international investment exposure?
Well, because I'm long-term, and I think in terms of decades, you go back and look at indices like the European index or the Asian or the North American S&P 500. In any year, everybody assumes the S&P beats everybody. That's actually not true. It only beats 50% of the time. So it really makes sense to have some exposure to other indexes or other markets. And so for Europe, I have a 20% weighting in Europe. And the reason I use Europe is there are 50, 60 companies there that are behemoths you've heard of, the Nestle's, Roche, American Tobacco. I mean, they're not American companies, and yet 50% of their sales, or sometimes more, are in the United States, and they're brands you know. And they sell at significant discounts to their American brethren. So, you know, do I want to, if I'm going to own consumer goods, why wouldn't I want to own Nestle? Now, it happens to be selling in Swiss francs in Switzerland. It's a Swiss company. So what? I'm happy to own it. Very strong balance sheet, really sustainable business model, and on and on. So I use, again, an index that I had a hand in designing, OUR, which takes the highest quality European, British, Euro, and Swiss companies into an index of 50, 60 companies that are very strong in terms of what they provide. And so it's a way of just diversifying my risk, but also buying great assets at a slightly lower price than what they're priced at in North America. So my answer is yes. Why wouldn't I? So OUSA, I complement. It's my largest holding, which is, you know, very high quality subset of the S&P 500. Companies that aren't going to be affected by major sectoral changes, you know, like energy and things like that, have been really devastated. I'd rather have balance sheets with high return on assets, and I have the same equivalent, 20% in Europe through OEUR.
So you've talked about some of the ETFs. I'm going to just ask you a question about outside the ETFs. Just people heard what the description was. In Europe, it's these global companies, Nestle, Roche, Unilever, Novartis, a lot of consumer and healthcare and so on. And these are companies that measure up very well for high level of profitability, very strong balance sheets. And Jake, of course, and his team know all about that. In terms of the investing that you do outside ETFs, I know you have, for example, in fixed income, a number of managers and investments that are not purely ETFs. Talk about the different ways you invest, not just in ETFs, but in other ways. You've covered private equity, you've covered ETFs. What are some of the other tools you use for investing?
I own a lot of fixed income products like bank loans, factoring, which is where I lend money to companies for their receivables to large big box retailers. I own BBB bonds. I own convertible debentures, pref shares. And across that whole portfolio, and one of the reasons it's no longer 50% of my portfolio, the returns for an average weighting of about 40 months is 3.2%. Now, you know, relative to bank interest or maybe money markets, that may sound attractive, but I'm taking duration and quality risk there to make 3% or 3.2. I don't find that very attractive anymore. It's a tremendous amount of work to go do these deals and get positions in them. That's why I'd rather be more in equities. But, you know, when I talk about the portfolio, I have a significant amount invested in those assets. And, you know, it's just showing you how much pressure there is on investors to look outside of fixed income. 30-year government bond yielding less than 2% is not a good investment. That is a risk, because if inflation shows up, the mark-to-market value of that bond is going to go down 20, 25%. So I would not be buying that, and I used to own the government bonds. I don't own any of them now.
There's another question that I'll phrase it a little differently than Jake did. And then, Jake, I'm going to invite you to come back on the screen in a minute here. It's just about ultra high net worth investing, Kevin. And you talked about how you invest. You have a lot of business partners, colleagues, friends. that are also wealthy people. When you look across that population of people that you know very well, what are some of the common characteristics of how they run their money? What is the mentality? What are they looking for?
Number one is after they've made their big liquidity event, which could have been decades ago, they have become incredibly diversified. The biggest risk you have in investing is over-concentration in one asset class or sector. And the ones that have remained solvent, because not all of them have, never took big bets again. They sort of lived by the code of no more than 5% in any one position, no more than 20% in any one sector. The other characteristic is a reduction in the use of leverage. Some of them do use leverage. I don't. I choose not to. I'm still challenged by trying to deploy capital. Why would I borrow it? So that's an issue. And the other thing that I now respect for the ones that have been successful over decades is they understand the concept of liquidity. I mentioned that earlier. But the opportunities that come to you are often in the times of extreme stress. And if you don't have cash sitting around, you can't take advantage of them. Sort of a Warren Buffett type theme. So, it's not bad to have some powder dry so that you're able to make decisions quickly. Even though that gives you zero return, there's value on liquidity. And so, I would say those are the attributes. And the one that's overriding all of them is the concept. None of these people care if they beat the market. They couldn't care less, actually. They care about preservation of wealth. They care that what they have is there tomorrow. And so they're not trying to beat the market. They don't take inordinate risk. When I look at these, when we talk about investing, I can't believe how boring their portfolios are. But it's because they have learned through the hard way, along the way, that when you take inordinate risk, you ultimately burn, and you just don't know when.
So let's say now someone that sells a business, they just come into after taxes, $5 million, $10 million, $20 million. What would you tell them about do it yourself versus get an advisor? How would you suggest that they approach selecting an advisor?
Well, I have those people in my world right now. 15% of our portfolio, sometimes 20 in any one year, of our private companies is going through liquidation. They're being acquired, they're being merged. And I generally become an advisor for that family because very often it's their very first liquidity event. And we get to know each other over the years that we manage the business together. So I would tell advisors a couple of things they probably already know, but I'll just reiterate. Number one, let's just use round numbers. Let's say somebody makes $120 million on an exit, and after tax they end up with 100. They make the decision around that time, do I set up a family office and manage this myself? Or do I find 2 or 3 advisors and split the mandate up amongst them, 33 million to 3 advisors, that kind of thing. In the case of the one I'm working on now with around numbers of that size, it's going to be 3 different advisors. And so I would say the advisors that the biggest mistake they make from day one is they don't include the spouse or the significant other, which often turns out to be the person that mitigates risks and makes the decision because the other entrepreneur that made all the money in the first place spends all their time focused on that and never worked on maintaining the family in any way. So I would always bring the couple in together. That'd be step number one. And you're going to find out who really runs the show. And more than half the time, it's the other, not the entrepreneur. Number two, and this is a mistake that I see happen all the time. When somebody walks in with $100 million, they actually don't care about fees. They know they're going to get the best price at any mandate that they fund. They're not spending their time worrying about that. They don't care. Number two, there's a certain thing that happens in their head, and I've seen this happen multiple times. That 100 million, they give you that 100 million, make it 20 million, make it 10 million, it doesn't matter. That number is a watermark that they need to see in a statement each month. They don't actually, and I can assure you this happens, they don't look at what they have, what they own. They don't look at the fees. They don't look at all the disclosures that are piled into those statements. They look for one number at the bottom right of the page, the 100 million or the 50 million or the 20 million. And it's what's really crazy about it is it doesn't matter if it's 105 million that you somehow, made the 5% that year. They don't care. But if it's 99 million, it's the end of the free world as we know it. So your job is actually to be as conservative as possible and speak around the ideas of three different metrics: preservation, preservation, and preservation. So no one's going to pay you to take risk. You need to make your fee, and you need to make 4% distributable after tax, which is 6% pre-tax. 99% of clients that walk in with a high net mandate want that. And so I don't get it, once a client has been with you for a few years and you're able to hold the line on the net worth they gave you, you really have to screw up badly for them to leave, because they don't want change. And they don't care about fees, but they do care about maintenance and preservation of their wealth. And so if I were an advisor, I often say, I would be a great advisor today after what I've learned working with all these entrepreneurs. I would simply talk about preservation of wealth every day. Performance, I know I'm not going to get paid for, and I'm not ever going to take that risk, because at the end of the day, what they want from me is to diversify, be tax efficient, and preserve wealth. That's it.
So now, if you're the client, you're telling a friend, hey, you just made an exit of $10 million, $20 million. What would you look for in that advisor? You're not the advisor. You're helping somebody choose one. What would you suggest are some of the key criteria?
Well, I do go on those Zoom calls with the families, and I give them my opinion after we meet. Very often, because they're in a town somewhere or in a rural city or something, there's advisors they want to work with, and so they say, let's do a meeting and hear what they would do with the capital. And I simply listen. I'm just muted guy, and they're aware I'm there listening. And after the call, I give them my opinion. The advisors that never get mandates are the ones that recommend using margin, for example. You're walking in with $50 million. What the hell do you need margin for? You haven't even put it together. You haven't even deployed the capital yet. And they're talking about goosing returns on fixed income, 50% levered. That's insane. I mean, that people that do that to high net worth individuals are just total disservice. So I X those. Well, I don't X them. I tell them what I think, and I tell them that's a really bad idea, and here's why. I like the ones that say, look, I say, show us a model portfolio. Here's 50 million. When would you deploy it? How would you deploy it? What would it look like? I can look at a portfolio and any funky chicken stuff in there, any options, levered option strategies. A person walks in that is just sold their business, and they've never done straddles and, all of this complex option stuff. And you hit them with this giant option portfolio. That's a really dumb idea. So I just went through one of those, and I explained to the family what the advisor is trying to do. My point is, keep it simple and keep it boring, and just keep saying preservation. Nobody's going to pay you to beat the market. Nobody even wants that.
So you're advising your colleagues and entrepreneurs succeed to go with advisors that are conservative, protect capital, keep it simple. So I think now's a great time. Samantha, you're running the studio here. If we bring Jake back on, here he is. Jake, thanks for coming back on. I'm going to turn it over to you and fire a couple of questions at Kevin, if you like. And Kevin, if you can give yourself the 30-second answer so Jake can maybe take a few shots.
Sure.
Yeah, I'll do my best here, and of course, appreciate the time. I think I've seen every letter of the alphabet used to describe whatever recovery we might see here. So could you just provide some insight on where you think we currently stand, or what's currently factored into the markets?
I think what's factored into the markets is inoculations by the third quarter of next year and therapeutics in the first quarter. I think we're going to live with the COVID virus for another 18 months as a factor in changing consumer behavior. So we're in my view, we're still going to see trailing performance from travel, lodging, airlines. And there's really nothing. Even countries like Switzerland and France and best practice Nordic countries are seeing a respike in there because schools are open again, et cetera. So it's going to be a little bit muted in certain sectors. The underlying economy is in great shape because this isn't a traditional recession. We just turned off there's a tremendous amount of liquidity in the market. So I think you might even see new highs in certain sectors after the election when that issue is resolved. And I also think that there's a wonderful new America 2.0 going to emerge in the next 24 months, as I described earlier, about digitization. And I see it in my own portfolio of how much performance we're getting from these companies that figured out how to sell direct to customers. So I'm extremely optimistic. I just think you need to have more of a preservationist tonality for the next 12 months in terms of how you manage your wealth, and just own really great balance sheets and be very careful about speculative positions. If the company doesn't make any money and is flying high, I get it, but that's risky, and it shouldn't be more than a few percentage points of the overall book.
Looking at the private markets, it sounds like you're a little less optimistic than usual going forward here. And I know you just said that this isn't a traditional recession, but have you seen any down rounds from any of the next raises? Or are you anticipating this lingering in the foreseeable future in the private markets?
Palantir, I think, which just went public on a new listing strategy, was valued at $20 billion last year. Looks like it's going to come at 15. Uber was a down round for many institutional investors. Yeah, there are down rounds. The great thing about this economy is it did give some extreme valuations to certain new age digital, companies, but it's not like it was in '99. Most of these companies have cash flows. So I would in a zero interest rate environment, I think for private investments, targeting a 7% return is not unrealistic, because I work in the PE world, and the prices that are being paid, it used to be you'd pay 5 to 6 times cash flow for a private company. I see deals being done at 9 to 11 times now because the cost of capital is so cheap. But generally speaking, the vintage 7 years later, when you pay 10 and 11 times for cash flow, is your returns are muted, to say the best, and I would say 7% would be a good target. So I temper your enthusiasm, but my comments about liquidity should be heard. I like liquidity, and I like it when markets are highly valued. I like to make sure I have liquidity.
Regarding the international participation in your portfolio, using the OGIG as an example, you're sitting at a little over a third international right now. While that's not entirely innovation, but it is global internet dominance, do you see that increasing over time, or do you still see most of that coming from the U.S.?
Well, it was a 20% weighting, but it was such a phenomenal performer this year that it's now sitting at over 30% weighting. It's a very strong indice. It's not a value indice. It's a sales growth indice. And the reason I own it is I am using those very companies in my private portfolio to empower their digital shift. And so it's important that I have participation there. It is global. But I also have a good dollop, as I like to say, of OEUR, which is far more boring, far less spicy. Obviously pays dividends where OGIG doesn't. But the whole theme here is when you use these rules-based indices, you get forced diversification. I would not just want to own FANGs. FANGs are great, but I want more than just a few names. I want complete diversification. So OGIG gives me the FANGs plus the global internet giants, so diversification. I want sectoral diversification, so I don't just buy technology. I own OEUR and OUSA and OUSM. So that I'm in all the sectors that are going to do well during the next 18 months. But I'll tell you what the difference is. If you and I had this conversation, Jake, 5 or maybe 6 years ago, I would have had managers managing those equity positions. I don't do that anymore. I use rules that are disciplined across these indexes I just talked about. I use a lot of managers, but they're in the fixed income market now. I do not use them in the equity markets. I have been well served with the extremely efficient tax wrapper and transparency and low fees of ETFs. That's what I'm doing.
So I want to be respectful of everyone's time here. So I'm hoping to end on a fun note. I'm kind of putting you on the spot with a story. What is the worst pitch you may have heard off the show, just on the street, out in your normal life, that you couldn't believe somebody came up to you and said that?
Well, I have to tell you, it's a very crazy outcome because it's very recent. I was pitched a cat DNA test where you swab your cat and send in the test for its DNA. And the test costs more than a new cat. And so that was my comment to her. Now, through a perverse part of my team that analyzes these pitches really, really liked that deal. And they argued that there's 100 million cats, way more than dogs as pets, and that people are going to be sitting at home with them for the next 2 years through the pandemic. And many people want to know where their cat came from and what its potential ailments are going to be and all the things that DNA testing provides. So I actually am an owner in that business now, not for my own free will, but because my team wanted it, and it has been one of the best performing companies we have. Its numbers are insane. They were right. People are going crazy for cat DNA tests. I can't explain it, but it's probably going to be one of our biggest winners in Shark Tank history. It's absolutely insane. And I still say to people, you can buy this test or you can buy a new cat. It's people get attached to their pets, and I get it, but it's called Base Pause. A remarkable woman entrepreneur. I have to give her credit. I was wrong. My team was right. And they're just shoving it in my nose every day.
Again, I want to be respectful of everyone's time here. So I think we will close the Q&A with that. Thank you for that story, Kevin. On behalf of Mike Shillin and myself and everyone here at Shillin Wealth Management, I want to thank you all for your continued support. And we hope you enjoyed this conversation.
Thank you very much. Take care.